Whether it's delaying your retirement contributions, postponing debt repayment, or avoiding that investment account, putting off financial decisions is more than just a bad habit. It's a choice that could have lasting consequences on your plan for the future. Whether it's fear, discomfort, or simply the habit of delay, understanding the root of your procrastination helps you move past it. But overcoming procrastination requires more than willpower. You also have to change your perspective and usual processes. This might mean breaking tasks into smaller, manageable pieces or seeking guidance to build your confidence in decision-making. Remember, procrastination is a choice, but so is taking action. And by taking action, you're not just making decisions. You're actively participating in stewardship for both the present and your future. Let's talk about what you're missing out on when you procrastinate. When you put off investing, you miss out on growth opportunities, which are vital to developing a secure financial future. One example that clearly demonstrates this idea is the power of compound interest, which increases over time. Let's take a closer look. Compound interest is often described as the eighth wonder of the world because of its powerful ability to grow your wealth over time. Imagine you invest $500,000 that generates a consistent annual return of 7%. In 20 years, that investment would grow to over $1.9 million without adding another cent. However, if you delay that same investment by just 5 years, you would end up with about $1.4 million instead, meaning you'd potentially miss out on over $500,000 in gains from that short delay. Looking at those numbers, you can understand the importance of starting early. The stock market is forward-looking. Prices are driven by what investors expect, future earnings, business performance, and where they think the economy is headed. The economy, on the other hand, is backward-looking. It's measured by things like GDP, inflation, and unemployment, data that tells us what's already happened. Market projects, economy reflects. Understanding this disconnect is a game changer for investors. Once you realize the market isn't reacting to today's reality, but to tomorrow's possibilities, you'll start to see why short-term headlines aren't the whole story. And more importantly, you'll see how this knowledge can help you make smarter, long-term decisions. I've got a great real-world example that illustrates this point. Let's talk about the second quarter of 2020. I'm sure you'll remember this time as the period when COVID-19 came to the forefront. In those months, the pandemic brought much of the global economy to a halt. Lockdowns forced businesses to close, millions of workers lost their jobs, and supply chains were severely disrupted. GDP, a key measure of economic activity, plummeted at an annualized rate of 31%, the sharpest decline in U.S. history. Unemployment soared to nearly 15%, with millions of Americans struggling to make ends meet. It felt like the economy was falling apart. But what happened to the stock market during the same period? The S&P 500 posted a gain of over 20%. That's right. Just like a seesaw, while the economy was hitting historic lows, the stock market was climbing. Markets project, economy reflects. Why? Investors weren't focused on the bleak economic numbers. They were looking ahead. They saw massive government intervention, stimulus checks, drastically lowered interest rates, and other measures aimed at propping up the economy. They anticipated a recovery fueled by these actions. On top of that, a wave of new investors jumped in to buy the dip, afraid of missing out on what they saw as a rare opportunity. This is a perfect example of how the stock market isn't a reflection of today's economy, but an indicator of where investors think things are headed. Now you might wonder, why is diversification so important, Keith? Let's look at some examples to understand its impact. During the 2008 financial crisis, many investors who had portfolios concentrated in real estate or financial stocks learned a painful lesson when they saw significant losses. Limiting their investment sectors meant that when those sectors tanked, the entire portfolio took a pretty brutal hit. However, people who had diversified their investments across various sectors, including more stable ones like utilities or consumer staples, experienced less volatility and less loss. To be clear, diversification does not eliminate risk, but it can help reduce it. Not putting all your eggs in one basket helps minimize the impact of a single investment's poor performance on your overall portfolio. Here's another example. During the dot-com bubble in the early 2000s, investors whose portfolios were heavily concentrated in technology stocks suffered massive losses when the bubble burst. However, those with diversified portfolios that included other sectors like consumer goods and healthcare, they saw a more balanced performance, less drawdown, and consequently, a quicker recovery. We saw this again during the COVID-19 pandemic. Investors with diversified portfolios that included technology stocks, healthcare, and essential consumer goods, they fared much better than those concentrated in sectors like travel and hospitality, which were severely impacted. So how do you diversify your portfolio effectively? Well, you want to mix asset classes by combining stocks, bonds, real estate, and other assets. For instance, a mix of 60% stocks, 30% bonds, and 10% real estate might provide a good balance between growth and stability. Let's begin with a simple question. Why would you want to invest outside the United States in the first place? After all, the U.S. has some of the world's largest, most successful companies, right? Yes, this is true, but it's also true that not all economies move in sync. When the U.S. market faces a downturn, other regions like Europe or Asia may be experiencing growth. By investing across multiple countries, you're adding another layer of diversification, which provides another opportunity for enhancing returns and also adds an extra layer of protection to your portfolio. Think of it as building a solid support structure. If one pillar weakens, the others can still hold firm, keeping your overall portfolio stable and balanced. When you invest solely in U.S. companies, your portfolio's performance is tied directly to the U.S. economy, which can be great until it's not. Adding investments from other countries can allow exposure to global economic growth and tap into industries not heavily represented domestically. Often investors focused on U.S. companies say, but the companies I'm invested in do business globally, so I'm covered. I don't really need to invest internationally. The potential problem with this rationale is that those U.S. multinational companies often hold a lot of technology and healthcare and might be severely underrepresented in other important parts of the global economy, like basic materials. In fact, some of the most dynamic growth opportunities right now are outside the U.S. market. Take emerging markets, for instance. Places like India, Brazil, and parts of Africa are experiencing rapid economic growth and development. These regions are building new industries and infrastructures, creating the potential for high returns that you might not find in more mature markets. Historically, buy and hold has been a pretty safe bet. Take a look at this chart from Fidelity, which really drives that point home. Imagine this. In January 1980, you invested $10,000 in the S&P 500 index. If you stayed entirely invested through the end of December of 22, your investment could have grown to over $1 million. How is that, Keith? Over that 43 period, the market trended upward reliably, and that $10,000 just kept compounding. The numbers show you the power of time in the market, staying invested over the long term. But here's where it really gets interesting. We know that tactical investing involves timing the market, which means exiting and re-entering the market at key moments. If you do it right, it can mean big gains, no question. But let's also talk about the potential downside of dipping in and out. Because if you don't get that timing just right, it could have major long-term consequences. Going back to the chart, the data is pretty clear. In this scenario, if you miss just the top 5 performing days during this 43-year period, your investment would have only grown to about $670,000. That's a loss of over $400,000 compared to staying fully invested. If you missed the top 10 days, it would have grown to $480,000, a loss of $600,000 compared to staying fully invested. And if you missed the best 30 days, your investment drops to $170,000, which means you forfeited $900,000. And finally, missing the top 50 days leaves you with just $75,000, a loss of $1 million. Now think about what that really means. This 43-year stretch containing more than 15,700 days, if you had 5 days, that represents the tiniest fraction of the overall total. But being out of the market for just those 5 days could have cost you nearly half of your returns. It's crazy. Here's the critical lesson. The market's most significant gains often occur during brief, unpredictable periods. Attempting to time the market can lead to missing pivotal days. And the success of the buy and hold isn't just theoretical. It's backed by decades of market performance. Remember, the S&P 500 reflects the largest and most influential companies in the U.S. And its history proves that while the market can be unpredictable in the short term, it trends upward over time. Staying invested ensures you capture the recovery periods that follow downturns and the remarkable growth, especially present at the birth of the bull market. I'm Keith Demetriades. If you found this information helpful, like the video, share it with someone who might benefit, and subscribe for more practical strategies to help you manage your wealth with confidence and purpose. And remember, be a savvy steward. Make your life count.